Hello, it's Keith Fitz-Gerald, and welcome to the chilly Pacific Northwest to today's 5 with Fitz. First, we get a big dip, then a rip, then an early morning dip, and now another rip as we're talking. So what gives? Well, the answer is computers, and we've talked about this more times than I can count. Estimates vary, but something on the order of 80% of today's markets are computer-driven, with no regard whatsoever for fundamentals, valuations, headlines, or anything else. And unless you understand how the game is played, you will get separated from your money. It's only a matter of when. Fortunately, though, all is not lost. Tactics count more than ever. There are all kinds of ways to handle what's happening, ranging from the very simple dollar cost averaging to the hopelessly complex layered quant strategies. Whatever path you choose, get busy. You can do this. Remember, investing is ultimately a bet on optimism. The path to profits and wealth is paved with consistency, especially when the going gets tough and others chicken out. Bottom line is staying committed when others panic is what separates the winners from the whiners. So stay committed, stick to your strategy, trust the process, keep your eyes on the bigger picture. I know it's tough, but history shows beyond any shadow of a doubt that that's the most profitable course of action. Now, here's my playbook for today. Number 1, the Fed is a big nothing burger yet again. As expected, the Fed held rates while also reinforcing the widely anticipated 2 rate cuts narrative that has been so popular, and traders wasted no time in getting on the gas yesterday, meaning buying to draw in the FOMO crowd. Then, of course, came the obligatory rug pull this morning to clean out the weak hands, and we're back in rally mode as I'm talking. The decision you've got to make is the same one I've got to make, is A, whether you're in it to win it or content to let everybody else do that, and B, what you're actually going to do about what's happening. Personally, I'm going to break out my buy list, and I hope you're going to do the same thing. Number 2 today, time to buy SoftBank. Japanese SoftBank Group is acquiring Ampere Computing, a startup specializing in ARM-based server chips for $6.5 billion. The deal is expected to close in the second half of 2025, but the real story is why SoftBank wants Ampere so badly. I think there's a couple reasons. First, they get control over the ARM ecosystem. Second, they get an infrastructure expansion. And third, they get monetization and diversification. So it's not just about licensing through ARM anymore. It's about the umbrella. They're evolving from an architectural licensor to a major AI player. The question on anybody's mind is, should you buy SoftBank? A lot of people will, and good on them if they do. Good on them if you're one of them. But my POV is that there are better, more direct paths to profitability with other chip makers, especially when there's custom silicone in the works. But that's just me, so big Number 3 today, why the right REITs still rule. Now, Norway's $1.8 trillion sovereign wealth fund managed by Norges Bank Investment Management, and here's another mouthful, NBIM, have acquired a 25% stake in Shaftesbury Capital's Covent Garden and Seven Dials portfolio for, I think it's 570 million British pounds, roughly 739 million US dollars, valuing the entire portfolio at 2.7 billion pounds sterling. And that's not all. Earlier this year, they grabbed a 25% stake in Westminster's Grosvenor Estate for 306 million British pounds, and that brings their total London investment to 2025 for a whopping, I think it's 876 million pounds sterling. So anyway, why should you care about what's happening over there when you may be over here? And the answer is because the big money is shifting capital into hard assets like real estate when the markets get shaky. It's a classic move to hedge against volatility, protect against inflation, and secure reliable income. Now, here's an investing tip for you. Real estate, which is something I get asked about a lot, real estate value goes beyond physical property and rental income it generates. It serves as a reflection of the broader economic, social, and technological trends within whatever area you're buying. Now, when you invest in real estate, you're really investing in the economic engine that drives demand, whether it's thriving healthcare, booming tech hub, or even just resilient residential market. Even better, if you tie it to a major investing theme like the 5Ds we use to guide our way in the One Bar Ahead research product. Now, the right REITs, meaning the ones with exposure to strong, consistent growth trends, are still fantastic investments, especially if you know where to look and what to buy. Data, medicine, and longevity also apply to real estate, something most investors don't bother to think about. So how much of a difference does this really make? I get that question a lot, so try this on for size. One of my favorite REITs has returned 205.32% over the past 5 years versus the SPY, a popular ETF that tracks the S&P 500, which has turned in a very respectable 153.83% over the same time frame. Now, if you're doing the numbers like I am, that's a 1.3x performance advantage. And it pays a dividend of roughly 4% too, which I love, especially in markets like the present, because there's nothing like cold hard cash. Now, hopefully you've got this covered, and if not, you know where to find me. Today's number 4, JPM has introduced a new inverse VIX ETN. So the question is this a better mousetrap or just more cheese? JPM rolled out VYLD, an inverse VIX ETN designed to let investors short volatility. Now that sounds really slick, but let's break it down, right? Unlike past attempts, most of which flop by the way, VYLD scales exposure daily so that a 1-point VIX move equates to a 1% ETN move. Now, supposedly this helps limit drawdowns. Plus, according to JPM, it's been back-tested over 18 years of VIX futures data. Now, here's why I'm skeptical. Back-testing the VIX, especially today, is a joke. I get the idea, I get the concept, but it's still a joke. The index has changed dramatically over the past 18 years. So this is not only ridiculous at face value, but it strikes me as a lot like asking a guy with scissors if you need a haircut. ETNs are not stocks. You can lose all your money and then some if things go sideways. Now, investors who buy in will be trading a derivative of a derivative. VYLD does not directly short the VIX or track the VIX futures one-to-one, so don't make the mistake of thinking it does. And finally, volatility drag and roll costs will very likely eat away at returns when VIX futures flip between contango and backwardization. So these are some big ahas, some big gotchas. I want you to think about them. And here's the investing tip. Wall Street constantly rolls out products that make them big fat commissions and you and your money more vulnerable. So my suggestion is you stick to great companies with great CEOs who actually want to make you more money, not just use yours to line their products, or their pockets anyway. So stay in your lane, not theirs. And finally, point number 5 today. You're watching it. I'm trying an experiment, and I want to know if you like it. For a long time, I've had people tell me that they can hear my voice in their head when they're reading the 5 with Fitz every day, and I'm incredibly humbled. So we've decided to try a little experiment and release a video version of the 5 with Fitz, which you're watching right now, every day for anyone who wants to listen in via podcast on your way to the salt mines or on a walk or whatever it is you do when you're out and about. You will find this on my YouTube channel, which presumably you already have. Anyway, do go easy though. I know I've got a ton of work to do here to make it better. Finally, today's bottom line, millions of investors are getting bound up in the past. But the inherent contradiction in that is that the market is always a forward-looking mechanism. So invest, trade, and think accordingly. You got this, I promise. So thanks for watching, spending a few minutes of your time with me today. Let's make it a great day. See you tomorrow.